ultimately, how much realistically can be chalked up to the U.S. regulatory environment? Or is that really just looking at finger pointing and somewhere to blame?
No, I mean, it's extraordinarily challenging. In 10 years of being a market participant, 5 years full-time investing in this industry, I've never seen as challenging a regulatory environment as we have in the U.S. It's full frontal assault through the bank sector. Of course, I think that's been widely discussed, certainly through the securities regulators, the CFTC. Virtually every financial regulator in the U.S. Has acted virtually in unison this year in an attempt to marginalize the crypto space. We see attacks potentially being levied on Bitcoin miners in this country. So every possible conceivable mechanism to push the industry offshore is being explored by the current administration. And the reaction to that has been material. Every major firm that touches crypto is at least looking at other options. And certainly some of the largest ones are now looking to re-domicile abroad, whether that's EU with a new, clear rules of the road in Europe, whether that's a jurisdiction like Bermuda, or whether that's even somewhere like Hong Kong. So, in my career in the crypto space, I've never seen as hostile regulatory posture as we have in the U.S. today.
Well, Nick, on the subject of banking, which you referred to, I just got back from Capitol Hill and the Senate Banking Committee hearing on the failures of Signature Bank and Silicon Valley Bank. And frankly, there wasn't that much conversation around crypto or digital assets. Senator Lummis did ask about it, which probably isn't all too surprising. You had some commentary from Senator Haggerty as well. But by and large, it feels like the pointing the finger at crypto as a reason why these banks failed has kind of fallen out of the narrative. And I'm hearing less about kind of the choke point 2.0. What are you hearing about that?
Well, it's curious because the initial reaction by certain high-profile senators was to blame crypto. And of course, as the run, which was ultimately caused by interest rates rising very quickly, and potentially in conjunction with flighty depositors, as that run continued across banks, many of which had no venture exposure, certainly no crypto exposure whatsoever, it became more tenuous to blame crypto. However, what's colloquially referred to as choke point 2.0, that's still very real. Crypto firms continue to have an extremely hard time getting access to banking, especially transactional or FBO style accounts. Crypto firms continue to look desperately for banking connectivity, and the major banks the few outstanding banks that openly service crypto are under pressure. And there's been other forms of harassment against those banks, like Cross River just recently. So certainly not over. It's just that, it's clear now that crypto wasn't the catalyst for the bank run in the traditional sector. I think that much we know.
Nick, how much has this administration and this Congress clamping down on crypto dried up liquidity in the market? We also just heard from Shanali that, Jane Street and Jump are pulling back. As these firms move out of the U.S. offshore, what does that do to liquidity?
Yeah, we saw headlines around Jump and Jane Street recently. Liquidity conditions have significantly deteriorated in the last month, especially for smaller cap. I think for market makers that are making markets for coins which could potentially be deemed unregistered securities, there's now a lot of concern around maintaining those relationships. Even for the majors, liquidity has deteriorated. Bitcoin and Ether, which I don't think run any risk of being considered securities. One of the main reasons for that is the loss of the SEN network, the SIGNET network, these real-time fiat settlement networks that were administered by these banks that collapsed in March. That's when we saw liquidity really start to dry up. So it has hit the entire market. And that means for a hypothetical large trade, of course, your execution is going to be worse. So it's just much more challenging now for a large institution to deploy into the space. And so, if you look at the metrics, liquidity has, from a mechanical sense, deteriorated dramatically, and the partial exit of these large market makers doesn't help there.
What about other effects on the price, let's say, of Bitcoin, Nick? As the Fed was raising rates, that provided a real return alternative to the cryptocurrency, but now many expect that they'll plateau and hold at this level. At the same time, the bank failures that you mentioned have pushed a lot of people towards cryptocurrency as a form of maybe safer money, kind of the original Bitcoin thesis. What do you make of the price action we've seen thus far?
I think there's a narrative that as the banks fail, Bitcoin gets a tailwind from that. I think what's really happening there, mechanically speaking, is simply that people perceive that there will necessarily be new liquidity injections into the system as the Fed seeks to potentially backstop the banks and shore up the treasury market. And so even if rates hold here, there's other ways that the Fed can inject liquidity into the system. And I think ultimately Bitcoin is a relatively pure gauge of liquidity conditions. And so the relatively strong performance this year for Bitcoin, I think it's simply reflective of the market's anticipation of new injections of liquidity into the system, even if rates hold, especially as financial conditions get really difficult and the Fed is trying to find new facilities. And whether it's the bank, BTFP, or other ways to shore up the treasury market, I think really that's just what the market is doing and anticipating that re-liquefaction.
Well, Nick, we've heard that obviously the banking failures maybe support the thesis for crypto and decentralization. At the same time, we've heard the same thing or similar things about the debt ceiling and the questioning around the full faith and credit of the United States. That's obviously a conversation that is dominating here in Washington today, has been for some time. Ultimately, what do you think happens to the price of Bitcoin if we get a deal on the debt ceiling? Is that, take part in the risk rally that may result from what's happening in other risk assets, or is that actually detrimental to Bitcoin?
That's a great question. I don't think anybody wants to see an actual default. I think everybody wants to see an agreement reached over the debt ceiling. Bitcoin has decoupled from risk assets, actually, so it's a good question. It's behaving much more like gold than it is behaving like the S&P 500. So good question there. So hard to say, but regardless, I think we are going to see the Fed starting to get much more active in terms of supporting markets. Supporting the treasury market in particular. The debt ceiling is an interesting sideshow, but the real story is the significant level of indebtedness, which isn't going away. And that's going to be something government's having to deal with. Many of us think that the one solution to debt to GDP being 125% will ultimately be inflationary. And so I think that'll be supportive to the price of Bitcoin.